Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Sorry for my lighting, it's a little bright today. We'll get that fixed up. What we're going to talk about today, guys, and it's really important, is the fact that you have to look at what the Treasury is doing. And when we show you what the Treasury is doing, you're going to want to run for the hills and protect all of your assets. So, very important video. Without further ado, let's dive in.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
So Bob, once in a while you find a real gem in these charts. I mean, they're all good, but this one really stood out at me. And so I'm going to let you explain that. But I think that for all of the warnings we've given folks over the last few months, I think this is the one you really need to see.
Yeah, so you guys remember when you were a teenager and, you're waiting for your mom and dad to go to bed so you could sneak out at night? Well, there's been a game going on now between Janet Yellen at the Treasury and Powell at the Fed. And Janet Yellen is trying to outweight Jerome Powell in terms of issuance of the bonds because she's waiting for him to cry uncle and the lower interest rates. So what she's done, Phil, is, and we've talked about this before, and I think you've thrown the chart up here now, she has issued a mind-boggling number of T-bills.
Yeah.
And in the past, this was an institutional game, but because the banks have been unwilling and unable to pay higher interest rates, the public has dove into these things now as well. And so we're in a situation where we're way past the norm, but that's not why I want to talk about this today, because we talked about that before. So what? Hey, you're getting 5% on your money. Why are you complaining? There's cash, creating liquidity in the market, yada, yada, yada. But that's not what happens. So once that peaks, and because you were talking about this going into October, November, she has to change the mix, is that once that peaks, it's a giant sucking sound out of equities.
Right.
Towards the bond market. And every time it's done that, we've had big sell-offs. We had the big sell-off in 2008. We had the big sell-off in 2019. We had a kind of a sell-off here in 2022. And now we're going to have the mother of all sell-offs, Phil, because the issuance is just so out of control right now. And I just wanted to bring that up to you guys. And look, and the RRP is going up. It's in reaction to that. But she's running out of places and people to buy. And at the same time, Saudis are dumping our bonds. The Chinese have no choice but to dump our bonds. The Russians have already dumped our bonds. And I think we're in big trouble here, Phil.
I totally agree. So I'm going to talk about the mechanism a little bit here, right? So the T-bills going up, and what you guys have to think of it is basically a form of QE, but instead of coming from the Federal Reserve, it comes from the Treasury. And when we get heavy T-bill issuance, as we have seen since the debt ceiling raise. So remember, we said caution into that. When they raised the debt ceiling, essentially, she went crazy with issuing T-bills. And the reason for that is because that's what juices the market. So, of course, they want the markets to stay up. And because the markets have evolved, and so that's now what primarily drives these markets, okay? When they do that, and the reason why things have evolved is because we didn't used to have a reverse repo window that would take those T-bill issuances and then drain down. And when that reverse repo window drains, well, guess where the money goes? It goes into the equity markets. It goes into risk-on assets. It goes even into crypto. So that's why things have been held up. Now, you think, why don't they just do that? Just issue short-term T-bills and forget the rest and keep the market up in perpetuity? Well, because because we have interest rates that need to get paid back. And if you're only doing it on a shorter duration, you're going to create a curve in your debt repayment that is unsustainable. You would bankrupt the country. And I mean, you could argue we're already bankrupt, right? Because nobody gets to run a deficit like we do. But even that being said, they try to maintain a certain amount of acceleration on the debt interest, and it's just simply unsustainable for just to issue T-bills. So because of that, they try to cap T-bills at about 20 to 23% of total debt issuance. The rest of it is longer duration. And that's why we like to look at things like the 10-year as kind of a gauge for things that, encompass the larger macro picture. So like Bob mentioned, we're going to get into more longer duration debt being issued in Q4. And the reason why we know that is because the Treasury does something called a quarterly refunding announcement, or QRA. And basically they said we're going to be doling out about $300 billion in longer duration debt. So that's going to have a big build back into the RRP most likely. And when the RRP, the reverse repo window, builds back up, this market will come down. So that kind of gives you a good picture of Q4. What happens beyond that? Again, we have to kind of reset after that, after we get a pullback, and see where things are. And if we start going into a recession and then bonds start catching a bid, then it kind of takes away from what Yellen's doing to try to short-term pump the market, because now the macro forces can take over. And again, short-term liquidity pumps can override what's building in the macro, but ultimately when the macro cycle starts to roll over, you get a recessionary cycle, the macro will always win out, and then you get this catch down effect. So I think that's what's going on here, why people might be scratching their heads. For us, it makes a lot of sense that we are still up here over 4,500 right now, because we've kind of exposed what's been the sole driver of this market. But look at what Bob's showing you guys. Every time this thing spikes, and this is a gargantuan spike. I mean, scary stuff here, guys, because this precedes big drawdowns in the economy, big drawdowns in the market.
Yeah, and Phil, I want to make a couple points too. They are going for broke here. Remember, the Treasury is even a more political animal than the Fed. And the last thing that the Biden administration wants going into 2024 is a crashing economy and a crashing stock market. And she's had no choice but to do this. And we've had two lower highs, Phil. They're throwing everything with the kitchen sink at this thing, and they can't get the markets to all-time highs. So that's number one. And like you said too, number two is that when this money comes out, then everybody's going to pile into longer term bonds, and they're going to sit and they're going to wait to get that principal. And that's what we're going to do too, by the way. When this thing starts to wiggle, you want TLT, okay? And you just want to sit back. And in 2008, when the stock market went down 50%, TLT went up 100%. Okay, so we're going to get the mother of all flattenings here, and we're not going to get a real estate boost out of this flattening. We're basically going to be flattening on a high plane, and it's going to be the worst of all possible worlds, Phil. And that's kind of what I want to cover today. So, you guys want to just buckle up. That's why, when the bull bros keep talking about things are going to be normal again, okay, you have to understand what's driving this stuff. And it's just been all derivatives behind the scenes and liquidity pumps that are unsustainable. And, I'm telling you, there's going to be weeping and gnashing of teeth by the end of the year if this thing goes the way we think it's going to go.
Yeah, that's no joke either. I mean, I laugh at the analogy, but it's true though. It's going to be a pretty significant move, I think. So then we'll have to see, like I said, how does that play into us rolling over into maybe a more macro downturn with the recession, which we're long overdue, guys. Remember, recessions come every 6 to 7 years on average. We haven't had one for over a decade. So there's a bit of a reckoning that has to happen in that regard, I believe. Anyway, guys, let us know your thoughts. Please hit like and subscribe. Tell us what you think is going to happen out of this. That's a huge spike in T-bills. Do you think that's going to cruise on like nothing's happening and we're going to continue higher? Or do you think that we're right? This is going to be a significant downturn in the end. All right, guys, thanks for watching. Please hit like and subscribe. We'll see you on the next episode. Take care, guys.
Trade Union.